This video segment is a small part of what the market guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Well, good evening, everyone. It is 8 o'clock, right on the nose here Eastern Time. I'm currently broadcasting from Cedar Key, Florida. I'm very happy to say that Verizon has set me up perfectly with an unlimited data plan that's giving me high-speed wireless connection. And I was debating whether or not to attempt to broadcast from here, but I did 3 Skype chat tests and it works out perfectly. So hopefully you could hear my voice and see my screen running seamlessly. Now, again, for those who are joining for the first time, welcome. I'd like to lay out the format in which we operate here. I generally go through a market report similar to what I put out on the weekly market report, but I do like a Monday report and look at how the markets are opening up for the week. And then when I get through that and analyze the markets as a whole, I'll then take stock symbols from our guests and analyze your stock. After you've submitted your stock, please let me know what your intentions are for that stock, whether you're thinking about buying it or you already own it, or maybe you've just sold it and you're wondering whether or not that was a good idea. Put those comments in there so that I can get an idea of where you are with that particular position. I'm not going to make recommendations for what to do with your money. I'm just going to analyze the stock and basically give you my technical analysis spin on it. As you may have heard in the warm-up, Philip is dialing in and he says, aloha from Honolulu. I'm in Orlando, I'm in Cedar Key, Florida, and Philip is in Honolulu. Can anyone tell me, is there anyone out there that's calling in from another country or at a distance that's further to where Philip are? Let me know. I'm just very curious to see who's dialing in here. I know there were some people a while back that dialed in from Denmark. I had some folks that were dialing in from London, and of course those folks would be listening to this in the wee hours of the morning. But there are people that do that. They want to listen live. They want to get their questions answered. So to those folks, again, welcome. All right, this is the Market Guys website. I just want to highlight a couple of things. First of which, up here at the top is the video tab. And what I'm doing is this, actually at the end of this month, beginning of May, I'm going to be adding some more what we call market shots. These are very, very short videos that describe technical analysis concepts and trading strategies, along with what I believe is the most important one, and that's the risk management part, which is talking about the 1% rule. If you are not familiar with the 1% rule, please review this, memorize it, and commit it to your memory. This one video right there, the 1% rule, is what I believe is the cornerstone for success in trading and investing in the markets. And if you're not incorporating a risk management plan that limits your losses, right now I would recommend you turn off your computer and don't even look at the stock market. And as I go to my chart, you'll see exactly why. This is a stock I was looking at earlier today. It's Dick's Sporting Goods, ticker symbol DKS. And this is a 20-year chart of the stock. And you can see that for 20 years, although this stock has had volatility, it's been in an upward trend. It started out below $5. It's trading over 50, and it's within this trading range. And as I zoom in now to the weekly chart, you'll see a slightly different picture. This is a stock that's had its ups and downs, and it's just now forming a bounce off of this roll reversal, that roll reversal line right there. And why am I pointing that out? Well, because in the videos right here again, we have the roll reversal, which is right at the top left right here, and that learning how to draw that horizontal line is, again, going to be one of the most important skills that you can develop in identifying resistance and support, which in turn will also help you identify exit points as well as entry points for your positions. Okay, so that's the end of showing you the market guide video section. One other thing I wanted to show you, in more or less in what I do in the morning, I have IG Home. This is like Internet Google. It used to be a Google homepage. If I don't know what your homepage is, but you see in my address bar, it says IG Home, ighome.com. You could set up little windows here that could give you the news sources. Now, I basically look at all news sources. I look at CNN, I look at Drudge, I look at Google, I look at Yahoo, I look at Forbes. Why Forbes is not posting right now, I don't know. I even look at ESPN, because especially when you're getting into the Stanley Cup playoffs and things like that, believe it or not, there are some people that trade the stock market based on who's going to win a Stanley Cup playoff series. It's crazy, I know, but people actually do this. And I've even spoken to people, not recently, but way back, money managers, in fact, who have hired people to, more or less, fortune tellers. I know this sounds crazy, but I've actually spoken to money managers that hire fortune tellers to give them the forecast on the market. And when I heard this, I almost went off the deep end, because there are people that are saving their life savings to invest in the market, and they put it in the hands of a money manager who think they're, all the world's greatest stock picker. And it turns out that particular person was hiring a fortune teller. Crazy, but true. Absolutely true. I don't want to go there. It's not voodoo and tea leaves. Technical analysis is actually a very viable way to read supply and demand, and it is with over years of practice and many hours of looking at charts, you can fine-tune the skills to increase your percentage of accuracy. And that's what I want to do with each and every one of you. I want you to look at the markets, not fear them, embrace the data, and position yourself in the favor of where the money is flowing, and then immediately protect yourself against any loss or risk of loss. Now, look at the diamonds. I'm going to start with the diamonds. This is the Dow Jones Industrial Average ETF. You can see that my forecast line from last Friday was this diagonal line. Now, I'm not going to say I am wrong yet, because we still have 3 trading days left in the week. But I will tell you that so far, the forecast, it's a very rare occurrence, but so far, last week's market report and forecasts are not following the trend line here, what I forecasted. Now, let me show you why I drew the downward line. Here, this blue line is the 20-period moving average. You could see that on Thursday, we had a big green candle, and on Friday, we had a red candle on lower volume. You see that? There was a drop in volume as the stock was still trading below the 20-period moving average. So at this point, the charts are showing, on this day, Friday, the possibility of a lower market. Well, Monday morning, the market's open, the Dow gaps up. Tuesday morning, the market's open, the Dow gaps up once again. Why? Because of earnings. Earnings plays a big part in the volatility of the market. But I'm telling you, folks, there's an old saying, and I think I've said this at least 3 times today. There's an old saying that says, buy the rumor, sell the news. Earnings is news. Many times the earnings is hyped up and the news gets hyped up. I would absolutely not be buying into this market right now. I'm not saying you shouldn't. I'm telling you what I wouldn't do. I would not be buying into this market right now. And I'm not going to draw too many lines on this chart because I've used the forecast lines for next week. This is the point of resistance right here, the high on March 16th. You could see that high, if I were to draw a line, horizontal line from that point, we are approaching that resistance line. it would not surprise me at all if tomorrow we come in maybe a little higher and maybe even wind up with a lower market on lower volume. Would not surprise me at all. So be on guard for that. There is a lot of opportunity here in many of the other stocks that have gapped up like this. But when you see the Dow, and as I'll show you, the Russell 2000 and other major indices, when you see whole markets gapping up like this, and then you see a long string of stocks following suit with gap ups, the caution flag gets bigger, and I start waving it more aggressively because gaps fill 80% of the time. Now, with this forecast, I want you to take this as a lesson, because remember, no one, including me, is going to be right 100% of the time. My percentage of accuracy is close to 90%. This might fall into the category where I'm wrong 10%, but there's still opportunity to be had even when your forecast is off in that 10% of the time. So let me erase this line. I want to erase that so I have a clean chart for Friday. And let's go to a more broad-based index, which is the Russell 2000. Now pay very close attention here, folks, because this market today, the Russell 2000, gapped up, and it doesn't look like a big gap. The gap actually falls from the high from yesterday, which is 399.96, to the low today, which is 1,410 cents. So there is a very small gap right here. Now, why am I pointing that out to you? Because the Russell 2000 very rarely gaps. It rarely gaps because it is a much broader index than the Dow Jones Industrial Average, which is tracking 30 stocks. Russell 2000 tracks 2,000 stocks. So for a Russell 2000 index to gap up, it's going to mean that a lot of the stocks within those 2,000 are also going to gap up. So that's point number one. Point number two, there is another very minor gap right here, as you can see just by pennies. The Russell 2000 fills or has filled those gaps 100% of the time. 100% of the gaps on the Russell have filled. The Dow still has some unopened or unfilled gaps, but the Russell 2000 is something you want to pay very close attention to. We are also stopping, or the high came very, very close right there to the high of today's trading session. Very high, and then we started to sell off towards the end of the day. I would not be surprised at all if the Russell 2000 starts falling off later towards the week, and at which time I'll reevaluate our forecast and move on from there. So I have to, again, erase this line because if you've been following the weekly market report, these lines are what I drew last Friday, and I want everyone to see how that all pans out. Okay, moving right along to the Qs. This is the power shares, and you can see here we stormed up for 2 days in a row. It broke through resistance, but look at today's volume on this green candle. The volume already is starting to drop right there on the Qs. So that's the telltale sign that the buyers are starting to lose some of that momentum. Buyer beware. We're looking at, again, earnings surprises, and I think that could very well be a knee-jerk reaction. When reality sets in and the impact of what the market is all about starts to hit the institutional investors as well, you could very well see a pullback right back to this moving average. I'm going to go now to the spiders. That's the ticker symbol for SPY, is the ticker symbol for the S&P 500 ETF. You can see that we had yesterday almost a perfect doji with a gap up on lower volume as we approach resistance once again. Do you see the pattern here? We're hitting resistance, volume is lower, markets are gapping up, gaps usually fill. And one other thing I want to point out that we have seen on all of the markets so far is that the rubber band effect is in play. What is the rubber band effect? I'm going to go back to my educational videos and show you the video right there. Watch the rubber band effect and what that means. It's basically an analysis of how far the stock price has moved from the moving average. And if you go back in time, as I back up here, you'll see the stock, especially the S&P, does not like to stay this far away from the moving average. Notice back here, look at the distance from the moving average to the price. Look here again, moving average to price. Look at the, measure it. This distance right now, we might go a little bit higher, but if we go any higher from where we are right now from that moving average, we're going to match or even exceed the stretching points that we've seen in the past. Even on the downside, the market does not like to stay that far below the moving average. So again, the rubber band effect is a great strategy for trading. Option traders love it because it allows them to position themselves according to where they think the snapback will occur. And if you get to become very familiar with the rubber band effect and you combine that with all of the other signals and strategies that we use, role reversal, again, the rubber band effect, price volume divergence, patterns like bullish and bearish engulfing patterns, dojis, spinning tops, you combine that all together, and then what happens is you wind up getting, you develop a very, very good feel for the market, and then you too, your accuracy, your percentage of accuracy starts to climb with regard to your own forecasting abilities. Okay, did I not cover one? Okay, yeah, one other thing. Look at the VIX. Now, the VIX back here on Friday and back here on last Wednesday formed a back-to-back bearish, bullish engulfing pattern. This is one of the few times that I've seen in my career where we've had two back-to-back bullish engulfing patterns that failed. That's important there, folks. Very, very few times have I seen back-to-back bullish engulfing patterns on the VIX and the market went the other way. Not only that, but the VIX has dropped dramatically, and now the rubber band is being stretched on the VIX on historic lows. Look at today's low. Right here, and I'm going to have to eventually erase this line. Let me draw the line here. I'm going to do a price level right at these lows right here. And I'm going to cross as many as I can. Lows, lows, lows. Back 2005, 2006, 2007, we hit record lows on the VIX. Where are we right now, folks? We are within pennies of record all-time low for the VIX. Please do not ignore this. Do not ignore what's happening with the VIX. The VIX is one of the best leading indicators, and when you see the rubber band being stretched below it, and you see bullish engulfing patterns that have failed, but now we're on key support levels, you have to pay very close attention to that, because on the weekly chart, again, another very important thing, this is going back 3 years. Notice, folks, the weekly chart has gapped down on the VIX. In the last 3 years, how many times has the VIX gapped, either up or down? Can you count them? You can count them on one hand. Let's see, who wants to answer that? How many of you can notice from this chart how many gaps there are that, hold on, there we go. How many gaps have we come into existence, and of those, how many gaps have filled? Well, of the gaps that have formed, with the exception of the gap that formed this week, that's 100% of the gaps in the VIX have filled. So if this gap winds up filling, and I strongly believe it will, and the VIX starts to move up, what does that mean for the general markets, particularly S&P? That is extremely bearish for the S&P and the general markets. So let's go and move out of the website. Let's move out of the webinars there. And now that we've done the forecasting, let me see if we have where did my Q&A box go? I just had it. Hold on. There it is. Okay, folks, and I see David. David, you said that you submitted your questions via email. I do not take email questions for the Q&A sessions. I'm not going to hop back and forth to email right now. If you have some questions, I'll take those. If they're more pertinent to your account, then maybe we could take that offline. But I'm not going to go back to email. Sorry about that if you had submitted stock symbols. So let's go right to the top right here. Herschel, oh, you're calling from Ottawa. Oh, thank you. All right, Dennis is looking, I believe AMAT is Applied Materials, and Dennis says, I'm trying to buy in on a dip. Thanks, Dennis. So let's look at AMAT. I'm going to start off with the weekly chart, Dennis. Okay. Now, this is obviously in an upward sloping channel. That's an up channel, uptrend within a channel. And you can see that on the weekly chart, the stock has, it looks to me like it has gapped up. I have the screen. You can't see it, folks, but it's my Q&A box, and it sometimes gets in the way. So let me zoom in here. Now, let me just check to see if that is, in fact, a gap up. AMAT last week had a high of 40.09, and today's low, oh, it's right at 40.09. So there is no gap. However, it's only Tuesday on the weekly chart, and we have to wait to see if this volume increases or decreases. So that's what we're seeing on the weekly chart. We have a breakout of the high, but we don't see a breakout just yet on stronger volume at the end. We will see it at the end of the week. Now, with that said, let's go to the daily chart. Now, if you look at the daily chart, you'll see now a gap. You see a gap, and after the gap was formed, we have 5 days of consecutive up days where we have higher highs on each one of those days. Now, I can't say that the volume is increasing dramatically, but if you know about gap trading, and I'm going to keep going back to the videos here, Trading the Gap is a video that I have that explains these gaps. If you know anything about gaps, generally what happens after a gap fills, it takes 3 to 5 days before the buyers have exhausted and the market starts coming back to fill the gap. Generally, sometimes it's sooner, sometimes it's a little bit later, but we are on our 5th up day right now with the volume slightly lower overall. So what I would suggest to you if you're thinking about buying is I would put a price alert on your chart using the technology. If you're using Scotia, I think their flight desk has the ability to put price alerts. If you're using Schwab, I know they definitely do. E-Trade does, TradeStation does, TD Ameritrade does. If you are using web-based trading and not a dynamic platform, I do believe Google Finance and Yahoo Finance has a free service that will email you when a stock has hit a certain level. My point is, if this stock pulls back to the gap or even pulls back to a roll reversal close to the gap, let's just say it does this and fills the gap, there's an 80% chance that the stock will reverse. And once the stock has reversed, you now have a clean support level to gauge not just your entry point, but you have a place where you can set your stop. So let's say the stock gets down to, I don't know, 38.25. You buy your stock on the bounce at 38.25 over support. Put your stop maybe $1 lower at 37.25. It is not only below this gap fill support, but it's also down below this low right here. And that gives you a little bit more room for that volatility. So giving yourself a $1 risk per share is the best thing. But be careful. If you're even going to buy it tomorrow, thinking it's going to go higher from here, that gap is going to haunt you eventually because there's a good chance it will fill. And I'm not just saying that because of the gap rule. I'm looking at the gaps in Applied Materials over time, and you can see right here, here's I would say a comparable gap up where the stock gapped up, and then you had 1, 2, 3, 4, 5. This went on for a little bit more before pulling back, attempting to fill the gap, but it didn't completely fill the gap until it came here into October 13th, at which time it filled the gap, and then again, following the 80% rule, it goes up from that point. Again, I'm the messenger. I'm the one reading. You could either believe this or not. It's totally up to you. I say whenever I make a comment like this, I tell people, don't just take my word for it. Go back in time and pick stocks randomly. I don't care if you pick 10, 20, 100 stocks. Go back and look at their charts, find where the gaps are, notice where the pullback points are, and then keep your own percentage of accuracy with regard to these gaps. Now, here's a gap with Applied Materials. It's way down here at $20. Is there a possibility that gap will fill? Yeah, it's possible, but that could be one of the gaps that just doesn't fill, and it's the 2 out of 10 that the market particularly ignores, and then you move on from there. So, but you could still use it as a support level. If the stock does ever get down to 27 or so from the high 30s, and so you could use that as a key support level for your own trading as well. Okay, I know I took a lot of time on that one, Dennis, but hopefully that will help you. All right. Rick says, thinking of taking a long position in Amgen, the gap has filled. Okay, AMGN. Let's take a look at that one. Oh, there we go. Perfect example. And thank you, Rick. I almost wish I incorporated your question into the last example with Applied Materials. The gap has filled. Yes. I like the fact that this stock is now moving above the 20-period moving average. So there's a lot of good things happening here, Rick, and you might want to just go through the checklist. Number one, like I just said, the stock is closing over the 20-period moving average. Positive point number one. Positive point number two is that the gap in this whole area right here can be taken as a gap fill support level. So if you do buy it, you have a clear place to put your stop below the support. That's point number two. Point number three, the pivot point is forming, as you can see the V here, and it is doing so on successively higher volume days. So that tells us that the buyers are motivated. The other thing is you have to be very careful here, Rick, because if you're buying Amgen, it is a highly priced stock. It's $162 a share. I don't know if you're using an option strategy to take a long position in that or not, but if you do buy the shares and you're tying up a bunch of money, you have to make sure that you're putting a stop in place to limit your risk, because Amgen is one of those stocks that has volatile swings. As you can see, it's like a roller coaster back here, where at one point, you know, the stock was trading 170 and 3 months later it was trading 130. You know, so you can see that it does have the ability to sting you. I would just suggest that you keep your stop tight, maybe below this low, or maybe even just below the 20-period moving average. Okay, so I'm going to help you with that. David, if you could, I'd like to take your questions offline because it's washing the other symbols off the screen there. So I appreciate that. All right, Leslie is looking at GLD and GDX. Now, Leslie, if you could, I don't see your intention on that. Let's see. If you could just tell me briefly if you're thinking about buying it or you already hold it, I can go into it from here. Okay, let's start with GLD. All right, GLD is right at a role reversal support level. Now, my eye immediately caught that, and maybe for some of you it did the same. It's immediately pulled back to this resistance point. I'm even going to take it from here. Now, here is the horizontal line that I will draw as a role reversal. This gap is not completely filled, but let me tell you, it's filled enough to hold as a support level. So if you even want to look at this as a double support level right here, that's how I would manage the risk. That's number one. Number two, there's still a gap down here below the market. So if you're going to get into GLD, I would not bet the farm on this. I would trade it with the intention of possibly selling it at a resistance point or a breakout here, and then trading it back and forth from the long side. But I wouldn't get into GLD as a long-term investment. Actually, silver has become the preferred precious metal because of the price per share, and silver is even filling some gaps as well. So we might look at that later on as well. So if you decide to buy into this one, You still don't have a green candle, right? So the checklist would require a green candle, preferably a green candle over the 20-period moving average, a bounce with the green candle on higher volume. So you want to see the volume going up. I'm going to draw the bar looking like that down here. You want to see the volume going up as the stock is going up. And you certainly must put a stop below that. Now, if you're looking at GDX, which is, again, in the same sector, you could trade this at a cheaper price. It's basically it's a lighter version of GLD, but you're going to get very similar volatility swings. I'm going to erase all these lines because we've analyzed this for so many times that you might even get confused by those lines. But let's look at what's happening here as well. Can anyone look? Let me zoom in here. And Leslie, if you can do this, then that's great. But looking at this chart, can anyone tell me where we might find a role reversal support level? Can anyone highlight that just by putting a price? Look at that and tell me if you see a role reversal line that we can use as support. Okay, let me see. Leslie, okay, Amalia says 21, Robert says 22, Dave says 22, Diane says 21, Leslie says 25, 21, 25-ish. Well, there you go. I'm measuring the former resistance from these points right here, and I'm just going to drop the line right here. Now, it doesn't perfectly match up with the lows here, and that's okay. It is a general area of role reversal support. So you can take it and lower your support down to here if you'd rather use that lower level. That's okay. But what I'm seeing here, Leslie, right now, is that we still see a red candle, and we still see the red candle on higher red volume. We will probably see, let me get rid of that line and draw a trend line instead. We'll probably see a little bit lower before the bounce. And that's only because I see the volume increasing in the direction of the short-term trend. Yes, there are gaps above the market. Yes, those gaps will most likely fill. But if you do buy into it right around 21.5, 22, I would put my stop somewhere below both of these lows, and you might even go so far to put your stop somewhere below even the $20 level. So if you buy, you could buy the 21.5, 22, and still put a $3 risk per share on it. You could put your stop all the way down here at 19 if you wanted to, but you'll have to, of course, lessen the number of shares that you buy if you lower your stop. So in other words, if you put a tight stop right below support, you can buy more shares. If you want to give the stock more room to move, then what you can do is lessen the number of shares, but give yourself more room to breathe. That's the safer way to go, the more conservative way to go, and I'll leave that up to you for sure. Okay, so Leslie, okay, you said that I see two and one. Okay, so you got that. All right, now Ron is looking at CNP, and one of the key things is, and I'm going to point this out to the group here, Ron. Ron says, what is a good entry point for an investor? Ron, it's very important, and I'm glad you pointed that out, because investors and traders look at the market very differently. And let me remove all drawings so that I can show you how an investor would look at this. First of all, an investor who's long-term would look at a 20-year chart of the stock. And you can see that there is a very, very strong upward trading channel. You can see the channel. Here's the trend line connecting this low, connecting this low. This might have been just a bad print that they never corrected. I don't believe that the stock went to zero on that day, so I'm discounting that. But I'm connecting this low to these lows and projecting out. There's my trend line. Now, as an educational point, a channel line is basically a line that runs parallel to the trend line, connecting as many highs as you can while still remaining parallel. So it's giving you an idea of what the channel looks like. So an investor looks at this, and says, well, since 2003, the stock has been going up. As a cautious investor might look at this, a cautious investor will say the stock has been going up long term, but in the short term, it's gone kind of steep here, and I see a very long stretch of green candles. This stretch of green candles is called a stale green light. When we see long stretches of candles in one particular color or the next, it's safe to say that we're very, very close to that color reversing. So as an investor, I would most likely wait for a pullback, either to a new roll reversal line, or maybe even a pullback all the way to 20 to see whether or not it pulls back to the channel, the trend line, before going back up to the channel line. So right now, you could see, again, the candles are green in straight succession. We've got 6 days, 6 months in a row. But you'll also notice that over the past months, the overall volume, the average high volume on this is dropping. So when the stock is going up and the volume is dropping down, then that is telling us that the buyers, including the investors, are starting to exhaust their buying power. So I would be a very cautious buyer on a pullback, and I would wait for that pullback, because if the general market start pulling back, this is one stock, even if they're beating all earnings expectations, this is one stock that can very well pull back in sympathy with the market. Okay, SMG, Robert Kelly says SMG on U.S. exchange looking for a buy-in. SMG, let's put that in there. And again, we're looking at the monthly chart. Now, in a lot of the analysis that I've been doing, I have been using what's called fan lines. I think I have the video up here. Let's see, trading the fans. If I don't have it on there, that's the next one that's going up. I might have put fan patterns. No, I have to make sure that gets on there. Yeah, it is. Okay, here it is. Here's fan patterns right at the top. I'm going to construct fan lines, and while I'm doing this, I want to tell you that a fan line is basically measuring a trend, a former trend, and the current trends that are currently accelerating. So let me explain. Back in 1997, we had a fairly steady upward trend that even included this low right here. You see? Let me extend that out, and let me erase those lines. Hold on. Okay, I have to extend it further out to really get the full impact here. Okay, so I'm going to draw my line from here, connect them to here, and as many as I can back here. Again, I'm trying to catch as many of those lows as possible. It's not always exact, but that's pretty darn close to the penny. And you can see that there was the overall angle of the trend from 1997 right up until about 2004, 2005. Then what happened is, in the crash of 2008, the stock went into a more vertical move in the trend line. And you can see, you take the last point connecting in the previous trend line, and you use that as your new point, connecting the more accelerated lows. And I could even go so far and do this. I'm going to do right there, okay? Now you take the last point and that one, and you connect the next accelerated higher lows. And let me stop here for a moment to let you know that normally 3 fan lines or 3 successively accelerated trends is usually defining an overbought or overextended stock. Now, with SMG, now I know this might be a long answer to a short question, Robert, but I take the next and last touching point on the 3rd fan line, and now I go up from there, connecting those points, and you can see that even on the monthly chart, the stock has been going almost vertical. Now I have 4 accelerated fan lines. I'm going to switch to the weekly chart. We might even be able to find 5 fan lines out there. I'm not going to do that to you, but we probably could find another fan line, even if I went to the daily chart. Okay, let's actually go to the daily chart. So what you have here is a stock that's even accelerating off of the the fourth accelerated fan line. And so what that means is when you have a stock that is so accelerated on the monthly, weekly, and now daily charts, and you see it approaching a resistance area, and you see that all happening on lower volume, you see the lower volume here, yesterday and today, today's lower volume than yesterday, what does that tell you? You have to kind of just weigh the evidence. If the trend is already accelerated, we're approaching resistance, we see gaps below the market, the candles are turning red on lower volume, we see a wide divergence from the 20-period moving average, so the rubber band is being stretched. Well, what does that tell you? It tells me I don't want to buy it right now. That's what that tells me. Now, as an investor, you would have to wait for a pullback. It would be best to do that because this is a stock that's now trading 97. So if it pulled back to $90, you're talking about a significant pullback for an investor. A trader can wait for a pullback to the 20-period moving average, jump in, wait for the bounce, and then set a tight stop and not suffer such a big percentage loss. So right now, again, I would wait patiently on this one. First, wait at least to see if that gap fills, and then reevaluate to see if you have a pivot point at that role reversal point. I think you'll be better off for doing that. Okay, let's keep going. Ann is looking at HD, Home Depot. HD is Home Depot. And let's kind of recap what this might have come up in the last web seminar because I had the bounce here off of this support level, and that looks pretty close. Yeah, that looks pretty close to the day that we did the open house webinar last month. So I'm guessing that that was the forecast. Now that the stock is bouncing, going higher, there's a couple of things you have to analyze here. Number one, the volume is going higher as the stock is going almost vertical. So that is a plus. However, the stock, like the Dow, has gapped up 2 days in a row. So my forecast for HD, and again, this is recorded. If you want to check for accuracy, write this down. Home Depot trading 153.03. This is an inverted hammer. A long shadow above the candle tells us that towards the end of the day, the sellers pounced on this stock. So my guess is that Home Depot is going to pull back and at least fill these gaps. So if you're thinking about buying it, I'm going to erase these lines and go with the most current ones. If you're thinking about buying it, you might want to buy it on the pullback, and you might want to wait for a bounce to this role reversal support level right there, because former resistance here, once the gap is filled especially, could act as support. And so I would wait for the pullback, but I wouldn't try to stay out of Home Depot very long. And these next comments have nothing to do with my technical analysis. It has everything to do with cycle trading. We are entering hurricane season, and historically, Home Depot has done very well during and just prior to hurricane season because people tend to stock up on building supplies, generators, batteries, and such. And depending on, I know this sounds crazy, but depending on how active our weather cycle is with tropical depressions, you could actually trade against weather patterns and looking at Home Depot. Now, on the opposite side of the coin, insurance companies basically work inversely to Home Depot in this hurricane cycle, because if a hurricane hits, who are the big losers? The insurance companies. So that takes a hit in their earnings, and therefore the price of the stock tends to drop. So it's very interesting to look at cycle patterns that way, but I would certainly wait for the gaps to fill before taking a second look in that. Okay. Yeah, Ron, I see that you repeated that second time, and I think we answered that. Okay, so I'm going to move on to Philip. Okay, now Philip said WYNN, W-Y-N-N. I think that's it, right? Is that the WYNN Hotels or WYNN Casinos? Let's see, W-Y-N-N. Let's see if that's it. WYNN Resorts. Yeah, that's it. Okay, now Philip says, thinking of buying an initial position of 200 shares, writing out of the money covered calls against the position. Okay, this is more of an option question. So for those who are not trading options, bear with me. Now, one thing you have to see, Philip, is that this is very, very close to a bullish engulfing pattern. Not quite, but it is close. And that's a pretty impressive green candle on pretty impressive higher volume. My only concern, well, there's a couple of concerns, is that there's a gap down below the market here. You see that? And if I were to go to a weekly chart, I'm just guessing, but I'm guessing that the trend is accelerated and it has gone higher. So you have a role reversal resistance point up here. You see that? Role reversal works the opposite when a stock is broken down below support. So former support, once broken, then becomes a ceiling. Now, with that said, I'm not telling you not to buy, and I'm not telling you not to sell the covered call, but I am telling you that if you do sell a covered call, you may not want to go too far out of the money. In fact, you might want to go at the money or close to being at the money. So if, let's say you bought the stock tomorrow at around, I don't know, 118 or so, you might look to sell the June 120 calls. Again, I'm just giving you an example here of which ones. I think May with only 3 weeks to go, not enough premium. But if you sold the June, you could even sell the June. Why are the 120s in the money here on this chart? I'm wondering if there was some after-hour trading. Well, you could even sell the June 125 calls for close to $3. And I think that would be your best bet, because as soon as you buy the stock and sell these calls, you're lowering your cost basis immediately by about $3. So it's giving you a cushion. And if it continues to go higher, you're still going to make a profit. So you're putting yourself in a really good position while still being able to protect a little bit of your downside. Now, finally, Philip, and I know there's a lot more option traders on here than they'll admit, but if you sell the 125 calls and the stock starts to go down, you could buy back your 125 calls for a profit and then sell your 115 calls and take in another credit. So that's called the roll down, and it's usually a defense strategy to repair a position that might move against you. So that's something to think about as well. Okay, David is looking. I'm trying to keep up with everyone, and believe me, you are. You're keeping me busy here. David says CVS. CVS is CVS Health, and let's see, CVS large long positions. I'm selling calls up approximately 85 strike and puts, and you're selling puts at 70. I don't know if that's so wise to do right now, because here's why. David, if the stock starts to pull back and break down below the support, and the only reason I'm saying that is because I'll have to erase all these lines, is because we are in it's an elongated what's called a triangle pattern. Why are my lines not erasing? Here we go. Okay, so we are in a triangle pattern now that if I take this high connected to this high, and it could even be the beginning of a breakout, we'll have to see. But this is a triangle pattern. Now, if you are selling calls on the upswing, I wouldn't sell any in the monies, because if it's breaking out of this triangle pattern, it could very well go back up to 86 to fill this gap up here. I would sell maybe the $90 calls if they give you any premium. Maybe, do they have 87.5 calls? You could probably look at the June 87.5s. They don't have the half strikes. Okay, so you have to go with the 85s. I would go maybe with the 85s. And I would actually start looking to buy back your $70 puts, because if you buy back your puts, you'll be taking a profit on those. And then when the stock pulls back to the moving average, you could resell the puts and take in a bigger credit. So it'll only enhance your percentage of return, or enhance your profits. So hopefully that analysis helped you there. But For anyone thinking about buying this one, remember that gap. If this gap fills tomorrow and you get a bounce off of this, which will be a new support level for that triangle, the upper portion of the triangle will be new support. That could actually be a new entry point for someone who's looking for a good longer term stock. So that's something to consider right there. You know, if you're new to the open house Q&A session, then you're probably getting some good ideas. Even if you're just a fly in the wall, you know, the audience generally submits or usually submits stock symbols for me to look at the charts. And a lot of times we come up with really good candidates because we have so many more eyes on the market looking for trade candidates. And if you are in tune with role reversal and the rubber band effect and all these gap theories and such, then the stocks that are brought to the table here in these open house, it becomes something that is are stocks that you can add to your watch list. All right, so these are good ideas. I'm going to put CVS on my watch list. I don't think I have it on now. Let me just check. I have it alphabetized right now. Do I have CVS on there? I don't have CVS, so I'm going to add CVS just to keep an eye on that one, because if that is a triangle breakout, that could be another great option play for someone in the option markets. Okay, let's keep moving on. Leslie has looking to, okay, that was an answer to your first question. Lots of gaps on GLD, we got that. And these are answers. Okay, I'm looking, okay, George is looking at SLV, and George is holding SLV. Now, George, I will disclose to you and everyone, I've recently bought into another large position of SLV. And so I do have a bias spin on this, but I'm going to do my best to keep my opinion out and look at the technical charts all the way. Silver actually could go slightly lower, maybe tomorrow or the day after. And the reason I say that is because there is one tiny little open gap right there at 1653. Once that gap fills, now remember, that 1653 is only 15 cents lower than where we are right now. So I didn't want to miss out on the gap just barely filling and then have it rally and me miss a trade. So I started scaling into this yesterday on this green candle. I actually bought at the beginning of the day when it was down 23 cents, and then it rallied. Today, it came down a little bit more, but I have not exhausted my total buying power. So George, keep this in mind. If you're holding SLV and you have more buying power, you may consider cost averaging down only if it stays over this role reversal gap support, gap fill support level. Now, the stock has had a pretty significant downturn since the beginning of April. The rubber band is being stretched. The volume is still increasing on that red candle, but as soon as that volume drops and if that gap fills, I plan on taking the rest of my buying power and going all in on SLV. That's my personal position on that. Now, once SLV starts going back up, and if it should hit resistance up here around 1760, I might look to take some of those shares off the table and take a profit in an effort to increase the size of my position on the next down move. What I mean by that is I am parlaying the position. So every time I sell and buy back, I buy back more shares than I had the first time around, so that I'm slowly accumulating the position. Now, if you look at the weekly chart on silver, the reason I remain bullish on silver is because silver is still trading at levels below production costs. So you're actually able to buy it at a cheaper price than some of the silver miners are able to pull it out of the ground. So they are cutting back on production until the silver prices start going up. It's very similar to what we saw back in the 80s and even the late 70s. Actually, it's more of the mid 80s, when the oil drillers in Texas started shutting down the oil wells because oil prices started to drop. You know, after the embargo, prices started to come back down, and then all of a sudden oil started drifting lower. the oil drillers actually cut back on production because it was losing them money to pull it out of the ground. And they would only do it when the prices would go up. Well, what happened is when the oil production stopped in Texas, what happened is the supply started getting gobbled up. You know, if there's no production, supply gets eaten. And the same thing is happening here. So I feel extremely comfortable buying silver on the long side anywhere below $19 or $20. I feel very comfortable down here. And I've been trading silver since 1982. So my comfort level might be different than yours. Therefore, if your comfort level is not as comfortable as mine, then you just keep a tighter stop. That's all you have to do. Okay, I'm looking at the clock. I'm going to try to get a couple of more in. Heinz says ACTG. Let's take a look at that. ACTG. We might actually be going into my phone's talking to me. It was voice activated. We might actually be going into record number of stocks being analyzed here tonight. So I'm going to try to do my best to get a couple more in. All right. Now, Heinz says ATCG on the 3-month daily chart. Let me look at the daily chart now. Now, first of all, this could very well be. This is the weekly chart. And Heinz, this could very well be a cup and handle pattern forming, a complex cup and handle. Here was a cup handle that failed, but it could be forming a new handle here, forming a complex cup and handle. So over the brim here, aka the rim as well, over 7.5, this gets very attractive. Now, going to your point in analyzing it over a daily chart, you say that you see a triple bottom and possibly a head and shoulders building for the stock heading in the opposite direction. Well, a head and shoulders pattern, by the way, is usually measured on a longer time frame. Excuse me. And the head and shoulders pattern is it's not quite popping out for me here. I don't see a defined head and shoulders pattern. But what I do see is a good strong area of support here. And I see that the volume is dropping as the stock forms this doji. You see the doji right there? That's that cross. This is when the stock opened and closed right at the same price. Now, that's a positive thing because in most cases when you see a doji, it signals a pivot point. So there is a good chance that this stock could start moving over the 20-period moving average. Now, if the stock starts dropping below $5, again, this is the area of support, I would strongly recommend that you get out of that position as quickly as possible because the margin requirement changes below 5. And generally, when a stock closes below 5 for a series of days, the stock goes much lower because the brokers are notifying their clients to either bring more money in or sell the positions. And most investors tend to sell the positions rather than bring more money in, and that puts more pressure in the stock. But over 5, it looks good. Over the 20-period moving average looks better. But once it gets over the 20-period moving average, you have a roll reversal resistance line right there, right around $6.30 that I would take as an exit or profit area. I would get out. If I buy it at 520 right here, I'm out at 620. I would even be getting out probably around 610 if I had the chance. I'd take a 90-cent profit on a $5.20 stock any day. Okay, last one. Jim says OPK, earnings on April 8th. OPK. Well, this is earnings season. That's why we have so many stocks that are moving around with the volatility. OPK looks very strong, and if it has earnings coming out on May 8th, generally stocks will continue in an upward direction if all the fundamentals look strong. So I'm erasing all these lines. I'm going to draw your support level right here. That would be your get out point. And you have a bullish engulfing pattern today. So this looks pretty strong. This stock could actually rally right up into earnings and maybe even go higher after earnings. It looks to me like the volume is picking up slightly here on that bullish engulfing pattern. But right now, it's looking pretty positive there, Jim. I don't know. You didn't tell me whether or not you hold the position or think about getting into it, but I would say all looks pretty positive at this particular point. All right, as usual, I did not run out of content. I did not run out of stock symbols. You definitely doing a good job there. I just ran out of time. And I'm looking forward to the next monthly event, which is going to be the open house. It'll be the next Monday after April's expiration day. So keep your eye on the Market Guys website. Keep your eye on your mailbox, and I'll be sure to notify you. Folks, thank you so much. This is absolutely my favorite time of the month to be able to connect with you and answer your questions and analyze your stocks. I hope you enjoy as much as I have. Have a great evening. So long.
For almost 3 decades, Ajay Monti has motivated audiences worldwide about creating personal wealth and winning in business. His time-tested risk management strategies focus on ideas that involve a keep it super simple approach, also known as the KISS principle. These concepts have been delivered to people in over 16 countries around the world, reaching audiences in the millions. Ajay is a best-selling author of 2 books, The Market Guy's 5 Points for Trading Success and Take Charge of Your Money Now, both of which have been featured on PBS Television, Fox Business News, ABC TV, as well as Sirius Money Radio. As a financial educator and consultant, he has worked with some of the most recognized names in the financial industry. Companies like Bank of America, Charles Schwab, E-Trade Financial, Scotiabank, and TD Ameritrade's Thinkorswim. If you have ever been challenged with having to make a tough decision regarding when to buy or sell a stock, then help is on the way. The Options Oracle and Equity Oracle Alert services are designed to help you make those tough decisions. Ajay will not only help you find the best trade candidates, but he will also lay out the exit strategy for each position in an easy-to-understand format that anyone can follow.
Hi, my name is Ajay Monti, Chief Market Strategist for The Market Guys. For almost 30 years, I've traded stocks, options, futures, and even currencies. I've traveled the world teaching people just like you how to profit in the market using time-tested strategies that focus on risk management. You see, the secret to making money in the market depends on your ability to limit losses when you're wrong. In other words, if you want to make a lot of money in the market, don't lose a lot of money in the market. Now that may sound funny, but it's true. Most investors are challenged with 2 questions. The first question is, how do you find a good stock? Well, the best way to find the right stock starts with eliminating all of the stocks you would not invest in. This process of elimination is called stock screening. And our services help you overcome the odds so you're putting your money where the money is going. We're simply following the trends. The second question most people ask of me is, when is it time to sell? Well, if you don't have an answer to this question, then you might find yourself in a position where you're holding on to your stocks when things go against you. This is the worst thing you could possibly do because I believe this is no longer a buy and hold market. It has evolved into a buy and protect market. Holding on and hoping for things to get better is not a strategy. In fact, doing this will eventually lead you to a catastrophic loss, and you wouldn't want that. Our trade alert services help answer these 2 questions. Not only will I help you find the right trade candidate, but I'll also show you how to use the charts to manage risk. I don't use the charts to predict the future. I use them to protect the future. The charts tell me when it's time to get out as well as when it's time to get in. And that's what I'd like to teach you as well. We have 2 services, the Equity Oracle and the Options Oracle. The Equity Oracle is an alert service for traders who would like to trade only equities, whereas the Options Oracle is our premier alert service for both equity and option traders. Each alert is laid out in an easy-to-understand format that shows charts depicting entry and exit points. Risk management is our cornerstone of each service, so you don't have to struggle with the decision of when to get out or when a trade goes against you, when should I take my loss. The strategy is to use the KISS principle, keeping it super simple. As a bonus, you'll have access to a live Q&A session as well, each and every month. This is where you can submit a stock symbol, and I will analyze these stocks while we discuss the best trading strategies for each position. And it gets better. In addition to the alert service and the live monthly Q&A sessions, we're also developing a member page that will include instructional videos about how to get the most out of our service. Without question, this is the best trade alert service available on the market, and we look forward to having you as our newest subscriber. Simply click on the link below to subscribe. It's easy. Once again, I'm Ajay Monti, Chief Market Strategist for the Market Guys. Thanks for watching.
Enrolling in this service is easy. Simply click on the link below to subscribe, and your weekly alert will be delivered right to your email box. And if you act now, we will include AJ's best-selling book, The Market Guy's 5 Points for Trading Success. This is a first-time offer that will get you on the road to success and keep you there. Remember, if you continue to do what you've always done, things will never change. Positive results will only come after you have taken the first step in the right direction. We look forward to having you as our newest member.